to Carol, and he has a lot of you guys might know him and stuff. He's got a passion for ag. He's farmed, got a tremendous background on the financial sector and some other things. And I don't want to tell everything all about it, but so I thought I'd just turn it over to you, Carol. But we are pleased as iFarm to be able to offer this to our growers. And I'll just turn it over to you and let me know what I can do to help.
Yes, thank you. Thank you, Dean. Yes, good morning, gentlemen. It's a lovely sunny day here in Saskatoon where I am. And yes, I'm excited for the start of the season. I'm not farming anymore. I'm concentrating 100% on this new insurance product which has been created, which I want to share more details with you. Because the reason why I created this is because as a farmer, I realized there are lots of issues. And insurance and the risk management is not always there to cover you as a farmer. So my background with economics and investment banking, I've used some of that same techniques which the big companies use and just bring it down to a farm level so that farmers can manage with their own risk as well. So I created this insurance, and I'll give you a little bit of a background how it works. So it's called captive insurance. And yeah, so captive insurance is pretty much a very yeah, what's exciting about captive insurance is that it flips the traditional model on its head. Instead of paying premiums to external insurer year after year, you're keeping that capital working for you. So it's tailoring coverage to your farm or your ag business to the actual risk you are running. It's a solution built for forward thinkers and those who want more control, more flexibility, and the potential to turn risk management into a long-term financial advantage. In short, this type of insurance is your way. So what is captive insurance? So captive insurance might sound like something only the big guys use, and historically it was true, but that's no longer the case. So today, even individual farmers and regional agribusinesses are using captives to take back control of the insurance strategy. Instead of sending premiums away to a traditional provider, you're essentially keeping those dollars in-house. You're managing the risk while potentially building wealth as well. And currently there are roughly about 5,500 captives worldwide. So this is not just a theory, it's a proven model that's now more acceptable and accessible than ever to the agricultural industry. And of course, the value of all the captives that's out there is massive amount of money already. So, and it just keep on growing year on year on year. So who can benefit? So yeah, so everyone from farm to fork can benefit from this insurance. So it of course everything is agricultural based. So it's pretty much your crop income, your production income. So for farmers, colonies, and you can group and pull it for scale as well, and fruit and vegetable growers. So any kind of farmers, suppliers as well, the intermediate, because people are dependent on yield income from their farmers so that they have their business income as well. And then of course on the other side as well is the elevator companies, the corporate producers groups, the ingredient manufacturers, all the food companies I'm talking about, that they can all get this type of insurance as well. So the key benefits of captive insurance for a farmer is this graphic highlights a diverse toolkit we now have for managing climate-related risk. It's not because, of course, you know, as a farmer, it never rains too much and then it rains too much. It's never too wet and then it's too wet. It's never too windy and then it's too windy. You no frost and then suddenly just an unexpected frost. So, and that all impact, of course, your yield. So, and it's not just about traditional crop insurance anymore. We're looking at a full spectrum of coverage. So you can cover parametric hail. So your hail insurance can be included here, and even give producers more flexibility of what you want to customize, tailor-make that insurance specifically for you. So each of these pieces represent an opportunity to customize your risk strategy to the realities of today's and the market conditions. Uh, um, Whether you're a processor, a grower, or working in as an intermediate, there's something in this model for you. Ultimately, the goal is to put more control in the hands of those managing risk on the ground, where the impact is real and immediate. I know personally I had that experience, when was it, about 4 years ago, when the pea price suddenly shot up. Is, of course, crop insurance, their price where they insured the peas was much lower to where the market price was. And yeah, and which was not a good move.
Hey, Carol, before we move that forward, just put it back one, if you don't mind. So, just to be clear, one thing that's really unique about this system, I don't know if it's that unique, but as like we've got some things on there that are like carbon credit insurance, carbon intensity scores. Some of these things are in development and you may not consider them live today, but in terms of where the world is going, we want to make sure in any way we're able to make sure that we for our farmers are prepared for what can come. So as those things come to light and we are able to bolt in ancillary coverages that protect your farm or help you to take advantage and leverage opportunities to take it to market. Some of you guys may have delved into IP stuff, or maybe you, like when I was with G3, we had an affidavit thing we had to sign saying that we had non-GMO stuff, or we had to say we're not going to bust up the land no more, and so you get a bit of a premium for it and all that. So if you don't mind, Carol, can you explain very briefly what is coming? We've got some things that are trialing in 25, and then in 26 and 27, there's some executable things. I'm not sure what all does apply to Canada or not, but just briefly give a little update on that, if you don't mind.
Yes. So in terms of the carbon intensity scoring, we can calculate your carbon intensity score. So that means how much greenhouse gases that you produce in the production of your crops. In the future, that will be very important for the consumer producers group who's buying these your crop from you, because starting this year, the big corporates need to report on how much greenhouse gases they release in the air for the production of their product. My favorite example is always Levi jeans. Levi jeans need to say what is the carbon intensity score for this one pair of jeans. So how much greenhouse gases that they release in the air in the production of those pair of jeans. So Levi jeans got the control of their production process as soon as that cotton enter their factory premises. But before that, they don't have any control of how the farmer grows his cotton and how much greenhouse gases is produced. So the future looked like, example of Levi, they would like to go to the farmer with the lower carbon intensity score, pay that farmer more money because of the good management practices, because it will influence them in their reporting as well. So that's pretty much where the future is going towards. So on the corporate side, You call that Corporate Sustainability Reporting Directive, and also the Security and Exchange climate reporting, which all the corporates need to do. And that happens all starting 2025. And of course, no one's got that information yet. So it's going to be a mad struggle and hop around to get all that information.
On that note, Carol, can you describe how this year in 25 we've got to look at measurement factors, and then how there may be penalties for not being at certain levels and things like that? Do you mind commenting on that briefly on the end users side of things?
Yes, so of course already we know with canola, so Ceres Ag is exporting a lot of their canola at the end of this season to Europe, and Europe is requiring every bushel of that carbon of the canola that's going to Europe to say what is the carbon intensity score for every bushel. And if that carbon intensity score is not a certain standard, they will not accept it. So this Ceres Ag is really working in the background, trying to work out the carbon intensity score for farmers. And to work that out, you basically need 56 data points. So it's taking consideration your management practice, if you no-till, strip-till, or you conventional till, and then the amount of fertilizer you apply, if you apply any manure to your fields, if you do any intercrop or cover cropping with it, and then also the soil organic component of the specific field. So the penalty, the immediate penalty is almost for this company exporting to Europe, that they might not receive it because they don't have the right value of that greenhouse gas levels. And for the south of the border is it independent of what government there is, it's the Security and Exchange Commission that's got these regulations. They need to report that, and the fines are going to be it's going to be huge. It's really going to be big amounts for them. I was telling Dean earlier this week, Marathon Oil in the States, they actually started working with farmers for just ethanol production, where they gave 200 farmers $1 million each for their regenerative process, because so just to give you an idea what the impact they realize that's coming for them for fines if they don't help. And of course, the American farmers, yes, they do things a little bit different. It gives you a little bit of an idea how big this is going to be if these companies are willing to give every farmer $1 million. Does that make sense?
So thanks. I don't know if anybody's got a question or comment, but I do have one thing to state right now, and that is that you guys are going to be hit, if you haven't already, with all kinds of outfits with carbon this and that. There's going to be ones that are going to want to lock you in. You guys went through this back a number of years ago. So people were running around and buying your carbon and stuff, and those guys did real good that sold the dang stuff to you. But the farmer, in the end, what the heck did you get for a check? So we have an inverted lens in iFarm. We are farmer first. We are wanting to be ahead of the curve to assist you in getting your carbon scores and all that stuff. And as things come about, we kind of got it all built. Everything's ready to rock and roll. And then you have control over how you're going to execute your sales and all this stuff. And we will, I don't know of any other outfits that has that lens on it, but notwithstanding that, we want to be ready. And within this framework, why I brought it up at all is this is also going to be your insurance system with our helping you if you want us to, so that it becomes an asset for you as you go along. And so Carol will get into that in a little bit, but I just wanted to touch on that because I thought that was important. Even though you don't see, maybe you can't tick off a box and make cash on it today or tomorrow, there's some stuff coming. We want to make sure you're ready. So that's all I had to say.
Yeah, that's a very good point, Dean. Yes, there's definitely, the world is changing so quickly, and it is going to change.
Hey, Greg, we have a question. Greg?
Yeah, so we're looking forward, but the one thing when you touched on that, some guys have already sold carbon credits back in the day or whatever. Nobody has when you're talking of the looking forward, do we actually have the metrics or how this is going to be done and it's uniform, or like before guys were just running around saying, well, this is what we're going to do and you might get X for your carbon, blah blah blah. Is this a uniform thing, like everybody's going to this format?
Yeah, so Greg, carbon intensity scoring is going to be the bigger question mark of where everyone need to report your carbon intensity score. So it means in your whole production process of growing your wheat or your canola, how much greenhouse gas has been released in the air. So that will take into consideration all the fuel you use and all your equipment. If you use a dryer, if you use if it's irrigated and you use electricity, of course, for the pumps, yes, and then all the types of nitrogen you apply, and lime. If you apply lime is not a good one for carbon intensity score, because of course it's in the ground, you need to dig it out, the energy you use to get it out is quite intensive. So that calculation is going to be key for every farmer almost going forward. In future, I can see that people is not going to ask you how was your yield on your wheat, is what's your carbon intensity score on your yield. And that's going to be the introduction of the conversation. And if your carbon intensity score is good, then people would take it to the next level to discuss, okay, how many bushels do you have available? What grade is it at? Before they want to consider going forward.
Right. But do we have the math on that? Like, is that
Yeah,
universal math now?
Yes.
I'll comment on that quick there, Greg, just to keep her simple, is that right now, the gold standard, we'll call it, is the EU marketplace. Okay. And then in the US, they came out with this new thing called 45Z. So ethanol plants can pay premiums and all the rest of it. But as Carolyn mentioned at the front, there's a scorecard of 56 data points, which is kind of the universal benchmarking of stuff. And there may well be nuances and whatnot, but my understanding, and correct me if I'm wrong, Carol, but the companies such as PepsiCo, Quaker, Nestle, end users have adopted that. And more importantly, the insurance underwriters, like the big dogs, I'm not talking about Wawanesa or nothing like that, but I'm talking about the multi-billion-dollar insurance companies have adopted those standards as their benchmarks too. So you might see a bunch of different little things for this and that, but we are making sure that we have the standard as our benchmark. And as a subset of that, there may be qualifications for something that maybe it don't need all of it, but we're making sure we got it covered. Is that fair enough, Carol?
Yes, and Greg, I can calculate it today. So if you're interested to have a rough idea what yours might be, we can have a quick call and I can just calculate it for you. In the States currently, there are companies that's actually offering their service to calculate carbon intensity score at $8 an acre. So, and these guys are just, yes, they're doing lots of farms at the moment. But
right.
It's just something I can calculate for you without charging you $8 an acre.
Okay, well, Dean, I'll talk after this and we'll look to get something done up.
Yeah.
Be interested in that. Thank you.
Yeah, it's just so this kind of crop insurance, you fully self-insured and you can modify everything in the insurance specifically to your needs. So I'm working with a farmer at the moment who wanted specific weather insurance, where in the past he had weather insurance on certain fields, but when he had to get to a claim last year, the insurance company didn't want to pay out because they were saying, according to their records, that the insurance that the conditions didn't get met. And then he was asking, well, but where did you get the weather information from? And they couldn't give him an answer. And of course, he lost his premium on that. And of course, this year he's looking at other options. So the two of us are trying to work it out at the moment. And the thing is, I can't get weather data information for that area where those fields are specifically. So how people previously insured it, I don't know. It is almost just a thumb suck. So yes, and but it's something so specific like that. So how we will do it now is there's ways how I can get the information with radar for historical stuff, and then just going forward this year, we'll just use all his weather stations he's got on his land to pull that information in. So you're totally in control of it. You know exactly what information, where the source of the data is, and to make it more transparent for everyone in terms of what's happening.
Yeah, that's a very good point, Carol. And like we've had some other presenters on our call, and we're looking at those that have systems available for a farmer to do his in-field diagnostics, measure what's going on and all the rest of it. And then, as you know, once you have a certain company in certain zones, they can daisy chain all of that data together. So it's about that. And we've got some alliances that we're going to be, to the best that we're able to kind of help put those things together a little bit to help with some of that if a guy's flying blind on things, and we can defend it because there's some data to back it up. It's a lot about that kind of stuff. Eh? Greg, your hand's up. Did you have another question?
Sorry, no. Sorry about that.
All good. Thanks, bud.
Yes, we've got to make it as transparent as possible so that you know where all the information is coming from, and you've got to agree that the information is the right information as well. So yeah, everything is open. You'll see where every penny is going to. So there's nothing behind closed doors that anything happened that you don't know about. Okay, I'll move on to the next slide. So key benefits of captive insurance for farms. So it's a very customizable coverage. So because it's one of the biggest advantage of captive insurance, it's not that one size fits all. Unlike traditional insurance, we're often paying into a pooled system that may or may not reflect your actual risk. A captive is built around your own operation, your crops, your geography, your exposure. This means you're not overpaying for someone else's risks. You're only paying for your own risk and only your risk. So it's a smarter, leaner, and a more responsive approach to coverage, especially in this kind of a sector which is unpredictable. For example, I had a field where a 300-acre field, and it was almost on the edge of a valley, and of course, no one rented the land, and the land was lying there. And so eventually, I figured out whose land it was and went to them and asked if I can rent it. And of course, after year one, I realized what the problem was, because that field doesn't get rain. It is just how that whole valley setup is. All the fields around it, if it rains, everyone gets rain. That field does not get rain. I don't know how it works, but it's just that field doesn't get rain. So it doesn't matter what you're trying to do on that field. It is just impossible to grow anything. So the most I got over all the years there is 3¼ inches of rain. And then the farmers, the guys right next to me, lush, typically they're 12 inches of rain, not a problem, but not that field. But now it's trying to tell that to insurance, it didn't even make sense to insure it, because even with the Saskatchewan crop insurance, because yes, it just doesn't get any rain. So it's very specific to your farm. It's not a cookie cutter approach. And and it only pay for your risk profile, and you don't pay for what you don't need. So captive insurance isn't just about replacing what you already have; it's about enhancing it. So you can enhance your existing protection. So currently, also, for example, I've got farmers that got their Saskatchewan crop insurance, but they want to add insurance on top of it. So they want to spend the additional $150 or $200 per acre for the insurance, and that can be done. It's like fill the gaps that traditional insurance might leave behind, and you can customize it, evolve it over time, and even pool with like-minded producers to create something bigger. What makes it even more powerful is the fact that it's built on your own farm's data. It's not industry averages that might not reflect 100% reality what's happening on your field. For example, my example I just give you there. That level of precision leads to a better pricing and smarter protection. And here's the real kicker. In a good year, when you don't have major claims, you're not just throwing away the premium. You're building a financial asset that stays within your operation. I'll explain that a little bit later in more detail. So instead of your old pay and maybe collect model, you could basically create a very much of a long-term value, turning insurance into a strategic tool to not just a necessary expense. And that's the whole target of this, so that it can become actually an asset for you, not an expense. I'll move on to the next one. So the financial benefits for your farm, there are lots of benefits captive insurance can give you, and that's where it really starts to shine. Not just as a risk tool, but as a financial strategy. And with the right structure, you looking at a potential tax deduction on premiums, which I just need to clarify specifically on that. And also building equity in your own insurance company. That's a dual benefit that you simply don't get with traditional insurance. And in low claim years, those premiums are lost. They stay in your captive, working for you and possibly earning returns and building value for you as well. And because the assets are generally shielded from creditors, it also offers a layer of financial protection you won't find in most farm risk strategies. Over time, all this can help strengthen your balance sheet, which is especially important if you're thinking about expansion, succession planning, or improving your access to finance. So what we basically create is we create your own small little insurance company, and which you own, and you pay the premium into your own insurance company, and then the bulk of that funding then goes to the reinsurance, because you want to take all the risk away from your own insurance company. So we've got a reinsurance company that's taking that away. But a percentage of your premiums still stay within your insurance company, which is available. And if you don't claim this year, next year that value is still in your bank account, which you control in your insurance company, which will bring your premium then down for the following year as well. And so it continues until your little savings account is so big in your own insurance company that you don't need to continue paying any more premiums to an insurance company. You've covered yourself. Does that make sense?
Yeah, so just for clarity, did you want to cover off what happens if there is a claim now? Or do you want to, is there another slide? I don't have my brain on that right this second.
I don't have a specific slide on that, but yes, that's a good point, Dean. So if there's a claim, So of course, so if the first amount of the claim comes out of your insurance company, and then the reinsurance company pay the rest. And so that's how it roughly works. Does that make sense?
Yeah, like I don't know if you've got some scenarios, but what I'll explain is this. Some of the people I've talked to, they're farms of a certain scale or whatever. So let's say for argument's sake and easy ciphering, they pay $1 million for insurance. Okay. So what happens in this scenario is their $1 million premium goes into their own company that's been created. We look after, like Carol looks after all of the protocols and making sure licensing's right and all this other stuff, that you're in compliance with your own insurance company. And 75% of that, so 750K, goes to the reinsurer, who is, again, they're the guys that insure Wawanesa and all these other outfits. So we're at that level. Then what happens is there's 25% left, right? So 5% goes to administrating that, because you got to pay for all this other stuff. But 20% of that, or in this instance, 200K, stays inside your insurance company. That's your money. And what can happen is, with Carol's connections, do your own thing, I don't care. But that 200K can be invested and you get your X% ROI on it. So that an interest accrual occurs on that. So let's say that happens on year 1. On year 2, same thing happens. You never had no claim. We're able to deduct, instead of that 5% number, down a bit, because the account's created. So there'll be a little more that you keep out of that bottom part, but the 75% still goes to the reinsurer, right? And then that other one builds on top. So you had the 200K plus interest. We're going to add another 200K plus interest or whatever. And then that becomes your $400,000 asset that carries on. And we just perpetuate that until we get to a point where you're 100% covered. And I anticipate you have the option of reinsuring still with the other outfit, but ideally you're self-insured, right? And that thing is an asset that you can take to the bank and all that. So let's say on year 1, you have a claim. So you went and you give your 750K to these guys, and there's 250, 5% of which is admin. So you've got the 200K yours. You have a claim for 2 million. Your 200K gets cleaned out, because that gets paid out first. And then the reinsurer that had that 750K, they cover off the other 1.8 mil. That's how that works. The next year, you had a claim. What happens? Well, because of the scope and scale of things, your premium don't get jacked to a multiple of 1.5 times or something. The premium stays the same and all that. You start all over. You got your 200K, you put in the 750, go to the other guy. There's that admin thing that's already been paid, so that'll be a little bit less and so on. And it just carries on like that. So hopefully that's clear enough. If you guys don't understand, let me know, or we can have a visit after. And we'll have Carol will be available for some one-on-ones and stuff if you want to just shoot me a text and you want to know more. Did I mess up, Carol, or is that clear enough?
No, it's beautifully explained. Thank you, Dean.
Okay, cool. Yeah, cool.
Yeah. So the process is basically how the steps we will take on our end is, first we'll identify what kind of what do you want to insure. Do you want to insure your crop yields or just your revenue income? And if there's specific stuff you want to insure in specific to your needs. So as I'm saying, the specific farmer wanted the weather insurance included as well. And then I just go and work out all the different risk potentials that's there, and then of course relay it back to you. And then in our conversation, we'll basically step 3, we'll then calculate the premium, and I'll run the numbers based on the risk tolerance you have. If you want to have 85% coverage, 70%, you pick whatever number you want. If you want 77.5% coverage, I can calculate it on 77.5%, or if it's 59.4, I can calculate it on 59.4. And then when I'm finished with that calculation, I go to the reinsurance company. Well, first to the underwriting company, and because the reinsurer require another company to make sure that my calculations and risk assessments were correct. So the underwriting company confirm everything. Then I have a conversation with the reinsurance company, and they just give me the thumbs up. And at this stage, I haven't had an issue with, because they accept my modeling process. We confirm that they're happy to reinsure it, and as soon as they're happy to give me the go ahead, I come back to you and say, okay, yes, this is what the premium calculation is, and it's the reinsurance is happy to insure it, and then we go and form your own insurance company. And that insurance company which we form is no different than any other insurance company. You exactly under the same regulations as that insurance company. It's just you own that insurance company. The one requirement we have for that insurance company is we do need to have an annual general meeting once a year. But of course, we can just do it on phone or virtual. You don't need to be on the same place. But for regulatory requirements, that is something you need to do. And you've got your own bank account where that money is in, and you can control everything in that bank account as you like. And of course, it can grow, and because it's an asset for you, and it can contribute to equity growth, and in that captive, which builds a valuable asset for you.
I'm going to hop in for a second here. So just for clarity, you guys, like, I don't know if you understand the scale, like how important this could be, because y'all are used to, you've got your little shops that are insurance brokers. That's that level, right? And then they are an SGI outfit as an example, and then they do Wawanesa and SGI and whatever other things. And then you've got the Wawanesas, SGI, and so on. Your business is at that SGI Wawanesa level. You don't have none of that stuff underneath. You are at that level and then up to the reinsurer, and that's it. What that means is, instead of that 0.85% being captured underneath for revenue, you guys are retaining all that stuff, right? And that's what really intrigued me about this here.
Yeah.
Is it puts you just at a different level. And along with that, the flexibility of adding other things. Like we had a call yesterday with a guy, and he's got livestock, and what happens about this, that, and the other thing. And what's very cool is that we're able to add those things. And so it's going to be quite different than what you're used to. And we want to crawl, walk, run to make sure you're comfortable. But we can at this time create some quotes for you that are real. And along with that, Carol, if you don't mind, the thing has been proven. That's the other thing. We are beyond, we got to trial it and test this, that, and the other thing. Like Carol actually last year had some going concerns and actually executed the creation of these things and premiums. Do you mind touching a little bit on how last year went for guys that did that, or just give an example of something?
Yes. So one thing I want to add as well there, Dean, which you were saying, which I need to add as well, is, of course, it's your own insurance company. When you make a claim, you don't have an assessor coming out to assess the claim. It is, you just inform me you want to make a claim, and that's it. So, and within 72 hours, that money is in your bank account where you want it to be, because you own that insurance company. You control when you want to make a claim or not. Does that make sense?
I think that's pretty clear. Yeah. So yeah, go ahead. We'll talk about the example afterward. Go ahead and finish this here stuff.
Yeah. So yeah, so is captive right for you? So captive insurance is not for every operation, but for farms that meet this profile, it can be a powerful financial and risk management tool. But as I also said before, we can pool like-minded farmers together as well. The reason where there's just this limit in terms of for the ideal farm setup is just that the process for creating the insurance company and the cost for setting up the insurance company in year one. So for if you 500 acres or 2,000 acres, it is just not cost benefit for you. So we typically look at that operations roughly in that 10 million or more in revenue. So because that will give it a really meaningful insurance spend. But it's not just about size. Captive are best suited for farms that take this proactive approach to risk and maintain good historical records and are open to working collaboratively with a captive management team. So this is pretty much a long-term play. It's not one season fix, but for the right operation, it's a way to gain more control, retain more value, and build something that strengthens the farm across generations. We know we've got seed royalties coming, and we've got the right to repair and everything that's just been pushed on farmers. And who knows what's going to happen with government subsidized crop insurance. But it's something to think about, and you can prepare yourself for the future. So it's a very much a long-term perspective. It's almost like a little savings account for me, which you create for yourself, and for the rainy day when you really need it.
For it's like a whole, we'll call it a whole life program. So hopefully you don't have to collect and you don't croak, but you're building an asset as you do and all of that kind of stuff. One thing on that last one note you touched on is, so for those of you that are working with, or you maybe you've got a farm that is at a certain scale and you might not hit that, 10,000 acre threshold is kind of seems to be where we'll call it a sweet spot is, or good baseline is. What we'll be doing is, if you guys are okay with the collaborative approach, if you don't have that many acres and you're good with, put me in the pool, we'll have a pool, and this guy has in this soil zone and this soil zone all together, we come up with a number of that right amount of acres or more, whatever. And then we come up with the premiums, and therefore then internally, there's a little more nuances to managing how that would work, but you're not left out in the cold. There's a way of sorting that out that we want to facilitate if it's in your interest. If you're not, that's cool. But just so you know that farmers that are not quite at scale, you're not left out in the cold with this here thing.
Yeah. So the next slide we've got is the next steps. Or shall I hop to an example? I can hop over to my Excel spreadsheet. Okay, let me just get that quickly. Okay. I'm just opening this up quickly.
Mm-hmm. It's all good.
Okay, why doesn't it? There we go. Okay, I'll actually let me make it a little bit bigger that you can see that better.
Yeah, and if you guys are, depending on how you have it set up, you can go to a full screen mode, and you can go to change layout and it'll make it bigger. But Carol's got it. I can see it on my little screen, but just so you know, if you need to fiddle, you can.
Yeah. So this is an example of how I calculate the information. So all this stuff here at the bottom is historical yield information for the specific fields over years. And yeah, you can see I call it stochastic rating. So it's a little bit of the magic that happened behind the scenes of doing the calculation on the model, and yeah, more doing a little bit of Monte Carlo simulation on it to get these numbers out. But for example, this specific grower was saying to me that they want to spend a certain amount of money on their a top-up insurance. So, and yeah, so they told me they would roughly want to spend about $2.5 million on a premium for their 10,000 acre farm. And then and what they grow is oats, canola, and wheat. So what I do here is their average yield over the years is basically this field here. So if we look at canola, their average yield over the last 5 years was 51.8. And so, of course, I work it out very precise, so because that makes an influence in terms of the numbers that's being created rather than rounding it up or down. And I just add the pricing in there, and you can pick the price you want to insure against. It's not dependent on any specific price set. In this case, I just use the crop insurance pricing which they've got in there. But as you can see from this modeling, I'll just make it a little bit smaller. If you can see it all on one screen, might help a little bit better. That of course, if I change the pricing there to $20, it makes a little bit of a difference in the payout that's coming in there. So at 51.8 bushels an acre, and against that price, so this is roughly the canola cost per acre is roughly $908. So because it is basically just the average yield and the pricing. So that's what they want to cover themselves. So the top-up insurance they want to have, it basically comes down to $250 an acre, which then if I take that, do a calculation on a 3,500 acre, it basically cover them at 88% of that 51.8. Let's make it 52 bushels of canola. So, for example, that then means that if their yield is $30, the difference is to the trigger amount. With the trigger amount yield is 45. So 88% coverage of the 50 to 1.8 gives them basically 45 bushels cover. So, and if their yield is then at 30, the difference between that 45 and 30 is 15 bushels and 15 bushels roughly, of course. And then, so the payout per acre then for them on the top of they receive is the price you pick. You can pick the specific price you want to have. If you want to pick $250, or $25 a bushel of canola, you can see the payout is then $277 an acre. Or if you leave it what the price I've got in there, it just make it a little bit less at $268. So so all in all, then, if we insure the canola, the oats, and the wheat, and you can see oats, at that specific coverage which they've required, we basically cover it at 98% of the yield information. So, which is 139 bushels an acre. So, of course, if you trigger that and your yield is 120 bushels an acre, there is immediately the $19, 19 bushels different, which equate to about roughly $64 an acre for the insurance payout. But of course, it depends on the price you put in. If you want to put in a price of $6, it makes it a little bit different. So, and the same on the wheat side here. So wheat, their average yield is 64. At that kind of pricing which they wanted, is it comes down to 95% of coverage. But of course, we can change that coverage too. So if we only want 80% coverage, that makes a difference. So if you only want 80% coverage on your wheat, then it brings it down a little bit lower as well. So instead of where your average yield is 64, it brings it down to 51 now. But even if you want to cover it 75% of your yield, then it brings it down even more. And of course, it brings your premium down more as well. So it's just so customizable that we can play around with it according to what your specific requirement is. So does that make sense so far? Let me just get that. Sorry, I've pressed the wrong button here.
I think the big thing is guys I wanted you guys just to see that there is a calculation for it and whatnot. I don't remember if that insurance premium was for, we had done some trialing, Carol, on significantly larger farms too. So is that 2.3 million for premium correct for a 10,000 acre farm, do you think?
I just, yeah, it doesn't look right to me.
Yeah, so I think we had one that was maybe 5 or 6 times that in there. So just again, that was just
yeah,
it would be 1/6 the amount for that kind of thing. But key being is we wanted to let you know how we would calculate it based on your data. So if you got your what ifs and all this other stuff, that's the best way. And Carol can run through all those numbers and stuff and see where you're at, no strings attached. And if there's other things outside of that you're interested in beyond just the revenue, we can sort that one out as well. So, but I think that was really appreciate all that. That's a lot of information and it's a new way of thinking. And so for lots of folks, it would be, just kind of absorb it for a hot minute. Yep.
yeah. Yes, so I think I've calculated that, so that brings it down to a little bit lower at if you spend that amount. Yeah.
Yeah. Okay. Thank you. Yeah. Cool.
But as you can see also what Dean is saying in terms of we can sit here and play around with the numbers until you feel comfortable. Okay, yes, that's the level which I want to cover. And yeah, we can just, when we customize it specifically for you. So what trigger that is basically if your yield is hitting that trigger and you want to claim, you can claim. That's it. And as I'm saying is, you don't need an assessor coming out coming to try and assess what's happening, because it's your own insurance company. It's the payment from the reinsurance company is done within 72 hours to the bank account where you want it. Sorry, great. I'm a little bit over time here.
No, that's, yeah, you did good. You did really good. Well, I was yapping at the front end, so that's on me, not on you. So, what I'm going to do is I'm just going to stop recording, and it is now